Hey dividend investors, today I am going to talk to you about ZWC, which is a fantastic ETF up here in Canada. So if you're a Canadian, this is definitely a video for you. So let's get down and let's check out ZWC. Okay, so first off, ZWC is an ETF. What does that mean? It basically means that it's a holding that holds quite a bit of different stocks, sometimes bonds, depends on which ETF you're really looking at, but this one is a high dividend investor, and from there you can just assume that you're going to be getting a lot, and I mean a lot of dividends, and dividends are very important because that can help you retire early. So let's really look at what the key facts are. So first off, if you're looking to invest in this ETF, you would type in ZWC on your trading platform, or if you want to research it, you can go to the BMO website because it is a BMO ETF. So BMO is the ones who are behind basically investing for you in this case anyways. So personally, I don't look at net assets, but what I do look at, which is something that I don't have on this sheet, is the trading volume. Trading volume is very important. And trading volume, what does that tell us? Well, if there's only maybe 400, 500 ETF shares crossing the tape every day, that basically means that there's not enough volume. If you wanted to get out of the ETF, let's say you wanted to use some money and you just wanted to sell the ETF and get rid of it, then you can usually do it quite a bit quicker if there's at a very minimum 10 to 15,000 shares a day and going up from there. And in this case, the ZWC, from what I've seen the last little while, ranges from about 20,000 to about 45,000 ETF shares per day, which is plenty enough to be able to get out. Next is going to be the price of the actual stock or ETF itself, which can play a role into really deciding if you want to invest in an ETF or into a stock itself. Now, the reason for that is, well, it all comes down to your trading commissions. So with TD, for example, they charge about $10. Obviously, I'm rounding up a bit. So every time you buy, it costs $10. Every time you sell, it also costs $10. So you want to buy more than just maybe one or two shares, especially if it's only $15 per share for the ETF. So personally, I would go in with something like this at a very minimum 50 shares, which would ultimately cost around $750. So let's say we had 50 shares. What can we basically guarantee or hope to guarantee or try to guarantee ourselves? Because of course when you're trading, you're not guaranteed 100% on anything. But you can look at the history and really see what is really going on with the individual stocks. So from there, what we are looking at is an annualized distribution yield of roughly 8.5% if you invest at that price. Now, we want to really look at what's inside of the ETF. What is it holding that is able to pay us that 8+% dividend for the long term? Because we don't want to invest in something that's going to be 8% for only maybe a couple of months and then it dips down because they just can't afford it or anything like that. So we really want to see what is it holding. Well, it's holding CIBC, which is fantastic. And why I say CIBC is fantastic is because right now they have one of the higher dividends in Canada, and it is fairly safe. Banks are a really safe bet to make, especially Canadian banks. I know some countries it's a little bit more riskier, but in Canada, almost every single loan, if you're not from Canada, almost every single loan is guaranteed by the government. So, it's pretty safe. Manulife is also fairly safe, and I should also say any Canadian bank is pretty well safe, not including Laurentian Bank, mainly because they have been paying dividends for well over 100 years, and they have never lowered their dividend, but they have kept it at the same level for a couple of years, like in 2008. when they didn't increase the dividend, but they still kept on paying it. BCE, which is Bell, essentially, they are pretty well safe until SpaceX starts taking over the internet market here in Canada, which probably won't be very long. And then we have Enbridge, which is an oil company. Oil companies tend to always make money no matter what. They always find a way of making money, but that part is a little bit more riskier. But Enbridge is a massive company. Canadian National Railway used to be a really big play on the oil market, but that has since really died down because of the price of oil. However, grain shipments, they're finally catching up on all of that, so it seems pretty solid. Shaw is another internet play, and same as TELUS. Both very high dividends, and very rarely that the telecommunications companies really mess with their dividends. Sometimes they'll give a special dividend, but other than that, they are pretty well safe as well. So as we can see here, the dividend is pretty safe. Something else that I like to look at as well is the performance chart, because we can always look at the history of what the ETF is doing, and then we can kind of take a guess on where it's going to go depending on what it's holding in its pocket, essentially. So as far as those companies go, there's going to be a little bit of pressure when it comes to right here and beyond. There's going to be a little bit of price pressure when it comes to their stock prices because COVID kind of sucks, and it's attacking Canada's market a lot harder than the American market because the Canadian market, the Canadian government, and the Ontario government, and so on and so forth, continue to lock down the country, while in the United States, you guys are continuously opening up unless you're California, New York, or any other democratic area, and I'm not getting into the argument of politics on this channel. At least not yet. So anyways, what I like to look at is a nice solid, hey, back to where it started if it's kind of recent, and to me 2017 is kind of recent too, roughly 2 years later, just so we can get an idea, and it's roughly 12% over 2 years. So that to me seems like it's got some pretty good history when it comes to the price. And then from this point all the way to recently, before this big downturn because of a virus, we can see that it was able to get up to 17%, which is huge, especially considering that that's only roughly, I'm going to say, 3 and a little bit of years. Well, 3.5, let's call it. 3.5 years, you're up 17.3%. That is pretty solid. However, now, when there's a downturn in the market, I always really like to look at how badly the downturn really was for the individual ETFs and how much money you would have been down if you sold at the bottom. So it went from 11.7 all the way down to about 70, if I remember correctly, 72, 74, somewhere in that range. And that's a massive downturn. Like, you are literally looking at over 25-30%, but then again, the market also went down that far. And to be honest, this would have been a fantastic area to buy in at, and I was personally buying in at that area, not on this ETF, but I was personally buying in there into banks, Canadian banks, CIBC. Also, BMO, Scotiabank. Scotiabank still got a massive dividend, as well as TD. I was buying a ton down in that area. I was actually, and I'm going to give you a little bit of a tip, I was actually buying all the way down this dip, and roughly around here, that's when I just started loading up. When I started seeing this uptick right here, this uptick, I started going all in on my dividend stocks that I was already holding, but I was buying more of them. I bought a little bit there, a little bit there, a little bit there. I actually bought CIBC right at the bottom, and a little bit of, I think it was like 50 shares, 40 shares, 50 shares, something like that, right at the bottom. And then when it came back up and it beat, and it came back off of that little spike that we had there, and it came back and stabilized for a bit, that's when I was really getting into the TDs, the Scotiabanks, and all of that. So Another thing that you need to look at as well is, will this suit your portfolio? Do you want to go the dividend route, trying to get a nice monthly payment? Because I will tell you right now that this ETF does pay you every month and not every 3 months or every year. It pays you every single month. So if you are going into retirement, if you are just looking for a nice substitute for income, so let's say you're working an hourly job and you want to have a nice dividend income to boost up your earnings every month, this is a great option because it's fairly stable when it comes to the dividend. The fund benefits, as it says here in their write-up, is designed for investors looking for higher income from equity portfolios, invested in a diversified portfolio of high dividend Canadian companies. And then it is a covered call ETF, which does reduce a little bit of the volatility, and it is professionally managed by BMO, like I was mentioning earlier. The risk rating is medium, so you're not going to have the massive highs and lows of the high risk rating. You're also not going to have the stagnation of low. You are in the middle. So generally speaking, in the middle, you can kind of think to yourself that you should be able to go up or down anywhere from 3 to 6% a year. And that is sort of the box that you're generally in within a 365-day period. Now, if you think that a higher risk is better for you, go for it, but always remember that when it's higher risk, there's also a higher risk of losing your money. Now, that was the ZWC BMO Canadian High Dividend Covered Call ETF. I hope that you have enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again in our next video.